All right. Matt, the mortgage guy, powered by You Mortgage. What is going on? Am I fuzzy on here? In today's episode, I am going to talk first and foremost to folks about how not to be a statistic. Folks are canceling at a higher rate than we've seen in a long time, to the tune of 60,000 canceled real estate contracts in June of 2022. I'm talking to real estate agents day in and day out, trying to help them avoid having buyers cancel. I've got two reasons why I think buyers are canceling at such a high rate. Let me figure out what is going on with the camera. There we go. Oh, crystal clear now. Is it having trouble focusing? What's going on? Sony A7 or whatever this thing is. Nonetheless, as always, 3 p.m. Pacific Standard Time, every single Monday, live Q&A. I'm going to give my little spiel, talk about some things that I see going on, how to help buyers, how to help real estate agents that are working with buyers, whether you're buying a home to live in, whether you're buying an investment property. And then we'll just jump into whatever questions you have. We'll take it wherever, folks who join live want it to go. If you're a real estate agent, if you're a fellow loan officer, if you're a consumer, no matter who you are, let's just have good conversation about the real estate market, what's happening. I'm literally talking to hundreds and hundreds of people every single week, not just in my market, but markets across the country. At You Mortgage, we've got 48 different states we're licensed in. So I'm dealing with folks across the country. The market is changing across the country. In some places it's changing more than other places, but nonetheless, it's changing. So as I talked about in the intro, we've got buyers canceling at, some would call it an alarming rate. 15% of contracts canceling. 60,000 is the number in June. Sounds like a humongous number. When you look historically, you see that 12 to 13% is kind of the average. So with that in mind, it's not the wildest number to say we're at 15%, but here's a couple things I want you as a consumer to avoid. And if you're a real estate agent working with the end buyer, please, what's the right word? I was going to say employ you. That's not the right word. When you ask somebody, it's like you plead with somebody. Whatever the heck the word is. First and foremost, as a buyer, get yourself fully pre-approved, because my guess is that some of these 60,000 buyers either did not qualify at all to begin with, or weren't keeping close enough tabs with their loan officer to know that when rates went up 0.5% or 1%, this $440,000 offer, they no longer qualified for that, right? And so make sure that as a buyer, you're working with a lender who's doing all the work up front. And trust me, we actually push people away because they say, you know what? I think I can get it done elsewhere with supplying less documents. Why is there a need to order a verification of employment? Why do you got to pull credit? Why do you got to see, pay stubs? What is this about averaging my income and getting the last pay stub from 2021 and 2020? Why would you like this written explanation of this? We're doing that stuff up front. More work on our side, better for the consumer, better prepared, knowing that we can get to the finish line, right? Don't be a statistic and be part of that 60,000 that canceled in June. Another thing to consider, if you're a consumer or if you're a real estate agent working with a consumer, make sure that along with this pre-approval, buyer has a really good idea of what the mortgage looks like. I can't tell you how many times buyers get out there, get themselves pre-approved, look at that pre-approval number, go out and find a house that matches that, get into contract, and then go, oh my gosh, $35.48 a month? I didn't know I was getting into a payment that big. I don't think we can swing that. That's when cold feet happens. That's when cancellation happens. If when you get pre-approved, you look at it and you go, okay, based on your scenario, based on property taxes, homeowners insurance, and all this, and 10% down, you're going to buy at $600. Here's what the payment, or here's what the rate is. Here's the mortgage insurance. Here's taxes in it. Like all in, your payment's $35.48. You're going to know that up front. You can decide whether you're in a good place to spend that per month, and that's part of your budget, or not, right? For some people, it might be a no-go, or it might be, hey, I got to start looking at stuff that's listed at $475. I got to buy a lower priced home because I need a payment that fits my budget. Do that stuff before you put in offers and get into contracts. Why in the heck isn't this thing working? Oh, there we go. It's driving me crazy. I don't know if it's just StreamYard or if it's for everybody. But anyhow, cameras dialed in now. We're good to go. Those are the two pieces of advice. Get yourself pre-approved and do a thorough job of it. Then with that pre-approval, get a good idea of what your monthly payment is, how it fits in your budget. Make sure you're comfortable. With all that information, a well-qualified buyer who's well-educated and informed can take that and bring it to the real estate agent and say, you know what? Up to $550 with 10% down, I'm comfortable. That payment makes sense. I've already looked at it. My current rent, my budget, all that, I'm good to go, right? Then you get into contract, you're less likely to back out unless, like there is all the time, an issue, $15,000 in sewer repair or something like that. But I have a feeling people are backing out, not being able to qualify, not very thorough pre-approval, or they do qualify, but they're sticker shock with the payment, right? So anyhow, I was just looking at a bunch of stuff from an event we did last Friday. Ryan Lundquist, good to see you. Amazing event here in Sacramento where we had Ryan Lundquist, SacramentoAppraisalBlog.com. My buddy Scott Groves, who's a real estate and mortgage coach, came out and talked to realtors about being famous with 50. Really appreciate the heck out of you, Ryan. I briefly, before we came on, got to look at some stuff over on SacramentoAppraisalBlog.com. I'm going to put the link in the comments. And I think that, as always, it's a home run. It's good no matter what market you're looking at, to look at something like this that talks about real estate data and trends and where things are going, what sold above, below original list price. Some of the stuff that is in that blog, Ryan, I can tell you, like, the exact words come out of my mouth when folks like the market's changing, I'm able to offer 50,000 below ask. And, you should always be offering below ask and this, that, and the other. The stats show that 40% of things are selling above asking, right? And so don't expect that every single listing is going to go below list because 40% of them don't. And other nuggets like that. I'll leave it to folks to go check it out on their own. Great graphs, great stats, great insight into those graphs as well. You'll have to check it out for yourself. Let me see if I can get to some questions here, and we'll kind of take this where it leads us. Why are mortgage rates going down, and will they keep going down? This is a great question. I don't believe that they're going to go down. Some people saw that, or some people are guessing that when we peaked above 6% last month, that might have been like the peak, and it's not going to go any higher than that. With all the things that the Fed is talking about and them doing the monetary tightening and whatnot that they're planning on doing, 100 basis points perhaps, or 75 at the minimum in their meeting next week, rates should be going up. The only explanation I have for why mortgage rates are going down recently, I guess it's a couple things. One is that with uncertainty, not knowing if we're in a recession or not, if the data is going to come out and show that we are in a recession, the future of the economy and whatnot, people are maybe fleeing to treasury bonds. And that 10-year treasury specifically, mortgage rates will follow that, right? And so as more money gets put into U.S. treasuries, that 10-year treasury, I think it's below 3% today, like 2.96. It was in the mid threes at once. As that gets pulled down, mortgage rates come down with it. Whether that trend continues, I'd be lying to tell you that I know for certain. A lot of folks that I've talked to where they're like 10% interest rates, 8% interest rates, that I can tell you with certainty, I don't believe I see on the horizon. If the Fed continues to have to tighten monetary policy and push up the Fed funds rate and do everything that they're doing currently to fight inflation, the stuff that has caused interest rates to go up, if they have to get more aggressive with that, we could see rates go up 6.5%, 7%. We're talking 30-year fixed, the stuff that most of us look at that are in the mid fives now. The good news for folks is that almost everybody, the Fed included, sees a U-turn from the Fed next year. So no matter what the Fed does, once they get inflation under control, they've said it with their own, through their own words, they're going to probably overcompensate, have to make a U-turn, meaning, get that Fed funds rate up to 3.4, 3.5%. Once they see inflation's under control, they're going to back it back down, and interest rates, by a lot of people's predictions, are going to be lower next year. How low? We probably shouldn't guess. Anybody who said like it's impossible for rates to go above 4% in 2022 should probably have their card pulled. No ability to guess on what's going to happen in mortgage rates in 2023. But, I'd be one of those people in that camp, right? I didn't think rates would go above 4%, but here we are. They went up a lot faster than most of us expected. Who else we got here? Fire your questions away. True. So Matt Bittner, I'll put up the first part to your question. 0.75 to a full point rate hike next week. Probably priced in, to be completely honest, Matt. Like, everybody expects it. The market shouldn't be surprised by any of that. Shouldn't be a big market mover. But to your point, the Fed hasn't meaningfully started shrinking its balance sheet, selling off mortgage-backed securities. If they did that, that would definitely be something that would drive interest rates up. So that is why, in my mind, like, all these interest rate hikes are relatively priced in. We know they're trying to get to 3.4, 3.5 for the Fed funds rate. The sell-off of the balance sheet and how fast they do that, or if they do that at all, could be the catalyst that takes us from the 5.5 now to 7. And I'm putting that, in my own mind, 7 as a cap. If they do none of it, we probably stay where we're at, or even trace back a little bit lower. If they do some of it, maybe we get up 6 and 6.25. If they do a lot of it, maybe we get to 7. Whatever the case may be, I think we're somewhere between where we are now and call it 6.5, and then only come down from there. I don't know. Part of that is some reasoning behind like what I'm seeing the Fed doing, and part of it's what do they call it? A good guess. As always, I'm not going to pretend to know about something that I don't. I have got very little knowledge about the Chenoa Fund, other than it's some sort of down payment assistance program, I believe. In the market we've been in for the last 2+ years, a lot of these programs, I think Chenoa, is it Chenoa or is it Naka? One of those where literally I heard those things took 6 months to close. Any loan program that took months to close, people just could not use, right? It was not a viable option. when things sold within 3 days and people wanted 17-day contracts with no contingencies. In a market that we're in or headed towards, where you might be able to write a 30-day, a 45-day, a 60-day contract, a contingent on another home selling. Hey, we're using this program. It's going to take a little longer, but we're going to get the thing closed. These kind of things might actually have a chance of getting accepted. So specifically on the Genoa, I don't know much about it, but I'm sure some Googling, whenever there's a specific program, a lot of those, I think like NACA and like will have designated lenders. Like, hey, here's somebody you can reach out to that's approved with us, has gone through our training course. Reach out to them in California. All right, Inessa, thanks for joining. Appreciate you being here. I think I might have skipped over some of your hellos up top, but nonetheless, I appreciate you. Hello, hello, hello. And here's something about the market that nobody's talking about. As we're moving to electric cars, people moving from apartments and condos to homes with garages to charge them. I mean, people had garages for their gas cars. And I think if more and more people are going electric, apartment complexes, I know the new stuff that's being built, I've seen it. They have, solar roofs on all their parking structures. They've got charging stations. And quite honestly, the demographic that's buying nice electric cars today, they're going to be staying in the nicer apartments who have these amenities built in. This is just my personal opinion. So I don't know how much electric cars will affect housing. That's my 2 cents on it. But, I saw a cool stat from Ryan about the size of the houses people were buying during the pandemic. They were bigger. And then I saw another stat from some home builder association. The houses they were building were much bigger. And so those are some things to think about, right? How big are the houses being built? And then my thought is as affordability becomes an issue, we see more multi-generational, more multifamily, more, types of things, ADUs, micro housing, whatever the heck they call it for some of these, mini homes, that kind of stuff. Since affordability, by some stats, I think it was Redfin that Ryan shared, 47% increase on a monthly mortgage payment year on year. That's wild. Simbo S, how do I find a lender in PA? I want to get started investing in my state, but don't know where I'm going to get the money. I have a safe amount to get started, like $20K, and more invested I can tap into. I've got a great lender for you, and I'll tell you exactly how to get in touch with them. Go to greatmortgagebroker.com, fill out the form. Connor is on my team, licensed in Philly, lives in Philly. He's a Jersey boy from Jersey, but he'll get you started. Go to greatmortgagebroker.com, fill out the form. Connor will personally reach out and, get you pre-approved for whatever you're looking for on the investment property stuff. I wonder if you don't own a primary, you should consider buying a primary, maybe renting out rooms, possibly even buying a duplex and renting out the other side. You can do that type of stuff with 3%, 3.5%, 5% down. If it's strictly an investment property you're not living in, then you got to go 20 or 25% down. But if you're looking to possibly purchase something that you could live in, and it could also be, a quasi rental property, either by room or another unit on a multi-unit, lots of options for you to go there. So greatmortgagebroker.com, hook up with Connor. He'll help you out. In a new build contract currently, closing is expected to be April, May 23 now. Signed contract February 22. How far out should we lock our rate and even see if we qualify anymore? I mean, it's a great question. I think that a lot of folks are going to tell you it makes sense to what they call in our world float. You're not locking the rate, you're waiting. April, May, I mean, that's still 10 months out, right? Anything that you lock now with a 12-month lock is going to be 6%. And I would have a tough time, especially with all these longer term locks. Lenders are starting to charge upfront, where they might say, hey, we'll get you 5.99%. You pay us 1.5 point upfront, whatever the numbers are, right? This is just hypothetical. That $9,000 is sunk cost. Make sure you understand fairly well, and you probably want to get a second opinion, what that lock entails. Can you float down? Can you float down multiple times? And for anybody unfamiliar, a float down meaning you lock in at 5.99, inflation gets under control. The Fed, starts lowering the Fed funds rate early next year, and you're able to get a 4.99 with no points next April, and you're locked into a 5.99. That's not good for you, right? Most lenders will have something built in. We're like, okay, we'll let you float down to that 4.99 since rates have improved. So look into that. Make sure that's an option. I'm gonna be taught something new tonight. At the very least, I'll learn one new thing. Matt, what is Fed jaw boning? I do not know if I've ever heard that term. And I'm telling you, you learn something new every day. Fed is jawboning to bring down demand and inflation. That's what I'm reading. Learning in real time. I don't know if we've got enough for my little brain to learn this. I do really good with mortgage scenarios and break-even analysis and simple math. Jawboning and really in-depth economics, probably not my strong suit, but we'll get back to jawboning later. I'll try to read this in my downtime, specifically when I'm having trouble going to bed. We'll dive into that. All right. Since you guys asked, or maybe didn't ask, I'll share with you guys a couple pieces of this Sacramento real estate blog because I think it's really cool. Let me find something. This is Sacramento specific. So anybody who's listening from Sacramento, tell me where you guys are from. There's 50 people currently watching. I'd love to know where everybody's from. Tell me if you're seeing the same thing in your market. Listings pile up. And when listings pile up, sellers have to start playing ball. You start to see 18 days on market, 22 days on market, 28 days on market. This is a cool stat. Average above and average below the listing price. Let's check it out. SacramentoAppraisalBlog.com. I should probably put that up on the screen. It'll be on here. All right. 2022. Below listing price. That's kind of interesting. I guess January is like a slower month, right? So those are winterish months where there's a third and then a fourth selling below list price. I'm gonna go down to 20 and 21% in a general spring. So we've got to 46% selling below list price in July, which is average. The question is, as we've like started so low in May 22 and gone to 46, like doubled, is it gonna stay on trend with the average and go from 46 to 52 to 55? Like on this left-hand column are all the averages, Or is it going to go 46, 56, 70, 75, right? Part of this stat and part of the reason for this huge jump from 22 to 46, in my opinion, as a guy who's just on the sidelines watching, is sellers that just don't realize it's not January anymore. It's not 2021 anymore. The market has changed. Let's see about the averages above versus what's going on 2022. Wow. March, April, May, 36, 41, 43 is the average. And we've got 72, 71, 68. So I'm guessing, just in my head, you add these two and then you got the rest that are just selling at the list price, right at the list price. Smart like that, right? Interesting stuff to watch because, again, way, way above average here and way, way below average on here with above versus below, and then a really quick course correction. And I think that's what everybody's paying attention to is like, hey, these numbers now look like normal. Days on market, number of listings, below ask and above ask, all normal-ish numbers. But we went from extremely abnormal to normal in 2-month period, really fast. And so, like, if I were to put this into simple terms for somebody who likes simple things like me, we've gone on this crazy trajectory of 15, 17, 20, some markets 25, 20, like ridiculous home price appreciation, and things selling like crazy in 2 days, no contingency, right? This, like, leveling off is a sharp right turn. Like this is sharp. Are we going to go sharp right turn and be flat, or are we going to even invert and see, enough to where it would cause home prices to come down 5%, 10%, 20%? Again, like I talked about earlier, it's market dependent. You might see a 20% home price decrease in Idaho. You might see Phoenix, Arizona fall off by 15%. You might see some markets with enough, positive migration and job growth and other things, go up 5%, 10% in 2023. It's really, specific. Oh, we got Jeanette, Stockton, California. We got Hotlanta, New Jersey, Tampa, Los Angeles. Prices holding strong. I wonder though, like what inventory numbers are doing, days on market are doing, prices staying strong. I think, they might look like that for a little bit, like they're flattening out. Portland, Oregon is selling like hotcakes. AJ, what's up, buddy? I know you're in Sacramento. In Sacramento too is one of those markets where if you're priced correctly at $399, you're going to sell for $420. If you're priced incorrectly at $450, you're going to sit for 30 days. Then you're going to decrease it to $430, and then you're going to ultimately sell for $415. And so, like, above, below list, it holds less weight in my mind because it's so subjective to what the seller actually lists that to begin with. But no doubt, the stat that stuck out to me was last year in Sacramento, we had a little over a half a month of inventory, 0.54, something to that effect. That was June of last year. June of this year, 1.74 months. So a 210% increase in months of inventory, and still not even to average or where we should be to have an even market, but trending up so fast that the question remains, like, are we going to go past the average trend line and into a territory where the market sees enough slowing? Oh, this is a cool one. Where'd that go? I'll show you this. This is from behind the scenes. I know Ryan doesn't mind if I share a couple of these. Of this presentation that Ryan did on Friday. This is Sacramento, months of inventory. Spike up here is COVID. We saw above 2 months of inventory because stuff was sitting, people were unsure and whatnot. Then once we got into July, August of 2020, we had less than a month of inventory for about 2 straight years, right? And then over these last 2 months, a significant uptick from, even April of this year, 0.68 months of inventory, 0.95, 1.25, 1.74. If this continues up, 2.5 to 3 months is kind of the average for Sacramento, where you're going to consider it an even market. If we get to 3.5 months, if we continue on any sort of trend line like we're on, things could change price wise and all kinds of areas, inventory wise. So it'll be interesting to watch and see what happens with inventory. A lot of clients of ours are already taking advantage of uncertainty in the market. That's what we have right now. We have uncertainty. Sellers have uncertainty. Buyers have uncertainty. Truth be told, your agents and mortgage folks have a little bit of uncertainty. What I know to be true is that, buyers need to look at their specific financial situation and figure out if it's a good time for them personally to buy. Not like, am I going to see a 5% reduction in prices? Are rates going to go from 5.5 to 4.5? Is this going to happen? Is that going to happen? The uncontrollable stuff is stuff that you don't necessarily want to try to analyze because you have no control over it. And really nobody has a clear picture of what's going to happen. The controllables are, how comfortable am I in my job, right? I think that's a huge one that people probably don't give enough attention to. If you've got, uncertainty with your job, that's going to affect you whether you're renting or buying, quite honestly. But you want to be in a position where the monthly payment that you're agreeing to and that you're signing up for on a mortgage is something that you can afford to pay month in and month out. Now's not the time to go out and stretch yourself and say, what's the max I qualify for? It's only going to remain sunshiny and I'll get paid more in the future. Get a real clear grasp on what you can personally afford. Look at the scenarios, and I'll show you too. Like, I've got stuff I'm looking at with clients on a daily basis. I just went over this with a client who was like, you know what? I've got at least 10% down. I might do 20% down if it means that I'm going to be in a safer spot mortgage payment wise. There's some gift fund availability from a family member, and they're analyzing the financials of it. So I'll share this screen too. Hopefully this is big enough where people can see it. Let's see here. Boom. You may or may not be able to see it, but basically what I have for this client is, here's 10% down, a $550 purchase price, no lender fees at all. You're about 5.5%. You got a $35.48 payment. If you're able to get the seller to give concessions to be able to buy the rate down, this is about 2 points to get down to 4.825. Then you've got a payment that's about $200 less, $33.42 a month. If you're able to get those gift funds that you're talking about and put 20% down, that same $550 purchase, you're $31.58 with no lender fees, or a couple points of rate buy down from the seller would get you 4.875 and $29.89. And really, this stuff people should be looking at it, trying to figure out, like, if $3,000 is your max mortgage payment, like, you know what, I can't pay above $3,000. Then you have a game plan, right? I'm going to buy $550. I'm going to put 20% down, and I'm going to get a couple points in credit paid by the seller to buy that down, or I'm going to pay those 2 points up front, whatever the case may be, right? You've got to be really clear about the financial part of it before you go out and start submitting offers. Way back to the beginning of this live stream, I talked about like that's why stuff falls out of contract. People don't have all these numbers dialed in the first place. I think that's kind of hard to read, but shoot an email to team@mtmg.com if you want to kind of look at that. Or if you're getting pre-approved, have a scenario specific to you. You're not necessarily putting 10 or 20% down. You're not necessarily 780 credit score. You're not necessarily, the same mortgage insurance premium based on credit and all that other stuff. So mortgage is very specific. Yeah. See, the funny part about this, AJ, is like you're, lover of real estate and property owner and real estate investor. It should be priced at 645. This is not always the realtor's fault. Sometimes it's just an unrealistic seller, and the realtor has to say, okay, well, we'll go ahead and list it at your price, Mr. Seller, but I promise you, you're going to hear crickets. And when you do, we're going to reduce it to 640. And so they've got to see those crickets for themselves, because the sellers want February's price and the buyers want February's rate. That's kind of where we're at right now. Not much space to build in Jersey left, so good homes in nice areas are in very short supply. Yeah, I believe it. It's like a lot of places. We're undersupplied. Whether folks call that like just propaganda or fast talk from real estate agents and lenders alike, like it's the truth. I think another thing that hurts supply is that a lot of folks who believe in real estate, long-term value of real estate, own it and aren't letting it go. And then it gets compounded when you've got institutions buying. What did I see recently? Like in Texas, like 40% of the stuff that was bought in 2021 was from investors. All right. We've got 20 minutes before I got to jump off. This is a live Q&A. So bring the Q so I can bring the A. I've got tons of different stuff I could talk about, but really I would rather, open it up Gary V style. That way we're answering people's specific questions that are going to lead to, detailed answers that are going to help more than just the person asking it. The other folks, no doubt, have the same questions. So big or small, whatever your question is, fire away. I'm going to look. I know we've had some, I don't know if I'd call it price wars, but we're having some interesting things happen in the, mortgage broker world, where mortgage brokers they're getting competitive. They're getting thin on margin. And I was just out of curiosity going to look at what Mortgage News Daily was publishing, because they're pretty close usually on an interest rate. But I think now, since we've had all this competition, margin compression, whatever the heck you want to call it, in the mortgage broker space, that how do I get rid of that? There we go. That rates are even lower than these advertised prices, right? Because 573, 577. The well-qualified buyers are closer to 5.5, truth be told, without even paying any points. So yeah, maybe this is the national average. Probably do a little bit better if you contact a mortgage broker. Which, speak of mortgage broker, today's National Mortgage Brokers Day. I forgot to, this is a special episode. National Mortgage Brokers Day. I should have said something earlier. Anyhow, happy Mortgage Brokers Day to all the mortgage brokers out there. Love you guys. We're like one big family, helping serve consumers at a high level all over the place. And with that in mind, let's see. Let's see what we got. What are you buying me? Oh, for National Mortgage Brokers Day. Yeah, I got you, Shaw. I'm going to buy Shaw a cup of coffee. Ryan Lundquist, are you seeing more FHA lately? For sure. I literally have offers out right now that I know would have had a lot of trouble getting accepted in 2021 just because of how competitive it was. And they're going to start getting accepted. I actually saw a listing today. Offer was made on behalf of our clients, and the realtor said, hey, look at this. I don't know what this exactly means. it said something to the effect of FHA offers being accepted, which was interesting, right? Like you would have seen like cash only or cash conventional on the agent notes in the MLS in the past. Perhaps place needed a little bit of work, but a quick note for folks, like FHA isn't as strict on the condition as people think. If you've got like a deck that's falling apart, yes, it's going to get called out. If you're, dude, I need a moderator in here for these. These are not very Christian comments that are coming across. So FHA is a product that I think your last stat, they'd gone from 10% to 12%, Ryan. I actually made a video today where I predicted that it'd be above 15% FHA in the Sacramento market by the end of 2022, just because it's a great product for first-time home buyers. It allows for 3.5% down. It's more flexible with, imperfect credit, more flexible with debt to income ratio for a number of reasons. FHA is going to be a better option for some buyers. And the rates are in the 4s on FHA stuff. So I think for sure, not only am I seeing more FHA today, like more is coming. No doubt. No doubt. How is the interest rate for 30-year conventional looking this month and next? Closing on my new build late next month. Without knowing anything about the scenario, I've priced a dozen loans today, so I could just tell you offhand, like great credit, not looking at paying any points or lender fees. You're in the mid 5s. If you were paying a couple points to buy down the rate, you're probably like 4.8-ish. Again, depending on the price, depending on your credit score, depending on the length of the lock, depending on a lot of things. That's, about what you're seeing today as far as interest rates go. And I'm guessing if it's a new build, you may already be locked, maybe not. If you're not, like things got a little bit better today. We're almost to the point where you would, right now, I guess if you're closing towards the end of August, look at the 45-day lock, consider that, or look at the 30. It's one of those things where, it's usually not worth the gamble. Sleepless nights, if it goes up a quarter and you're buying something for $500,000 and that quarter means an extra $100 a month, you don't want to risk it. Benjamin Fajardo. While trying to be really nice, I'm also going to be really honest. Things like lock and shop are generally, is gimmick the right word? It probably is. 60 or 90-day lock and shop isn't going to do you a lot of good. You're going to pay a premium for it because the lender is locking in a rate for you for 60 or 90 days. And so if your specific scenario calls for a 5.5% interest rate, and I say, I got you, man, lock and shop, 5.75. As long as you find something within the next 30 days and you get in contract, we can close before that 60-day mark, I got you. Or if you want the 90-day, I'll get you at 5.875. If rates go to 6.5, you are locked in. Rates aren't going to 6.5. There's almost no chance, right? So most people's like best practice is just going to be go out there and find a place, lock it when you are in contract. And these types of, lock and shops, 3-2-1 buy downs, a lot of gimmicky stuff going on out there right now. Ryan, come with all the best questions, brother. I appreciate you. What terms are you seeing in contracts right now? This is a great point and something I should have thought about bringing up myself. One thing that's really surprising me is contingencies. All of a sudden, in a market like Sacramento that was super red hot, like demand was through the roof, and it was wild for anybody who was in the Sacramento market over the last couple of years. And I deal a lot with like Bay Area stuff as well. And those two, like no appraisal, no loan, no inspection, like contingencies were just like, if you put them on there, you basically said, I'm not interested in buying this house. It wasn't that dramatic, but should have been, or was close enough. every contract I see now has loan, appraisal, inspection, and I'm not seeing like appraisal gaps anymore. Like that stuff just went away like this, like at the, drop of a hat. And so it's great for me to see 12 days for inspections, 14 days for appraisal, 17-day loan contingency, 25-day close. These type of contracts, like I just wasn't seeing even 3 months ago, right? So a lot more of that. And then buyers getting strategic and putting seller credits on there to either offset the cost of their closing costs or to buy down their interest rate. One of those two things. And so got one in contract last week with a $9,000 credit. I think I just saw one with a $4,000 seller credit. Sometimes this stuff gets negotiated in contract, but buyers are getting this stuff up front. And I think for a lot of buyers, buying a home is, one of the biggest hurdles is the upfront cost, right? So I'm going to put 3.5% down plus closing costs, and I'm prepaying my property taxes and escrow, and all these other things go into it. If that's $20 or $25 or $30,000, that's a heavy carry for a lot of folks up front. If they get $6,000, $8,000, $10,000 in seller credit, and now that $24,000 cash to close turns into $16,000, more doable for a lot of people. So I think it's a welcome sight for me as a mortgage broker and for buyers, I can imagine. And I'm just seeing a ton more of it, to be honest. So I appreciate the question. It's a good one. Jeanette 46, a good site to check mortgage interest rates. If you just want a general idea, this is the one I always point folks towards, Mortgage News Daily. They basically do a daily update, right? You can see last Monday through Friday, 577, 571, 572, 577. This is an average across the nation. I love for you to check this site too, and then come to a mortgage broker like me, because then you'll see the average is 573, and then you come to me and like, oh yeah, I can get you 5.5. But this gives you a good idea, right? And then you can check out this graph and kind of see what they've done over time at different dates. And you can go back and be like, okay, back on March 12th, it was this. And on February 23rd, it was this. March 9th, it was here. What's this date? Ooh, 6.28. Middle of last month, rates were high. And the good news is, I mean, on a lot of rate sheets, like we're in the mid fives. So Mortgage News Daily, and they're not going to try to like get your information and sell you a bunch of stuff, at least not yet. Yeah, peace of mind. Sneak Attack. Sneak Attack is the perfect screen name for the 2-1 buy down, because some of these programs are a sneak attack, right? To make you feel like you're getting a better deal. Here's what I would say about 2-1 buy down worth it if the seller is paying for it. If the seller is paying for it, it's great and all, but maybe that seller credit that's paying for the 2-1 buy down could be better deployed elsewhere. Let me give you an example. If you're working with a lender that says, listen, I know rates are high, based on your credit score and your down payment, we're looking at about 6.375. And you're like, holy moly, I should talk to Matt, the mortgage guy. I should talk to a broker. Probably going to be lower than that. Nonetheless, nice enough person. You've been working with them and your realtor says they're nice. They're in my office and they bring bagels. So you're working with this retail lender. You don't know any better. And I don't know. You don't like money. 6.375. But they tell you, we got a 2-1 buy down. So the first year is going to be 4.375. Second year, it's 5.375. Then the third year through the 30th, it's 6.375. The seller's going to pay it. So it's okay that it's $8,000 to do that, right? $8,000 in cost. The seller's paying for it. The two problems I have with it is, one, for that same $8,000 and with a mortgage broker, you could probably get a 4.99 forever and ever, right? You might refinance out of it in 5 years from now, but you might not. You might keep this loan for 8 years. And 4.99 and 6.375 is a pretty big gap. So you go 4.99 with that same buy down, and you're, kind of able to set it and forget it. You're not worried. The other problem I have with it is no idea what the payments are, but just in my head, let's call it $2,200, $2,500, and $2,800. Your payments over years 1, 2, and 3 because of that buy down structure. I hate that it gets you into the habit of paying a $2,200 mortgage payment when in 24 months your payment's going to be $2,800. That extra $600, you will find a way to spend it. More Amazon packages will end up on your porch. Your wife done found that extra $600. More dinners out will be had. Whatever the case may be, that money doesn't just go into a safe place unless you're really paying attention to your budget and you're really on it, right? And so your savings over the first couple years, in a perfect world, it's like, okay, you're easing into the payment. Your income's going to go up over time. But really, I think you just like lull yourself into budgeting for a smaller monthly payment when that payment goes up. I'd much rather have you go $499, just get used to $2,350, let's call it, somewhere in there, right? And now it's $2,350 forever, right? I like that idea. I think it's better, and the vast majority of consumers are going to do better in that long term, right? It's not as low as that first month, 4.375, or that first year, those first 12, right? It's $2,200 then, but it's not this false sense of like, hey, listen, I'm gonna get you in this house $2,200 a month. Cool. Knowing in 24 months your payment's gonna be $2,800. Use that same amount of buy it down today to $499 for the whole 30 years. That's my 2 cents. Hopefully that was helpful. Does new build rates lock in longer than 60, 90 days? Yeah, all lenders are going to have 120, 180, some of them 360-day locks. Probably not advisable to do a year lock. They're going to come with exorbitant fees. So I would not advise, but they're all available. So, everyone's scenario is so different. It's hard to give a cookie cutter, like this is what you should specifically do. Look at all your options, talk to somebody. If you're in a new build, here's a cool stat for you. 73% of people who buy a new build use an outside lender. And it's crazy to think that new builders do everything in their power to hold you tight, offer credits, tell you that your deal is not going to happen if it's not for their in-house lender, all that stuff. People have become smarter. The internet has created access to information. People are realizing that 73% of the time, you get a better deal talking to a mortgage broker, going to greatmortgagebroker.com, filling out the form, having my team contact you. Just kidding. You can use anybody you want. Just make sure it's a broker. Make sure they're offering you the best terms, saving you and your family Jeez Louise. You weren't kidding, Joey. How do I block Naked HD? Does that mean like I've made it when I got the spam bots coming after me? I need a moderator now? How do people get moderators on YouTube channels? Who do I got to talk to? G. Jumbo rates have fluctuated in general, depending on the products and the down payment. Jumbo rates are going to be in line with the conforming stuff, mid to high fives. And then if you're going to do an ARM, which makes a lot of sense on a lot of jumbos, then you can get sub 5%. All right. Are you getting pumped for the new data released by National Association of Realtors on Wednesday? Yeah, it's going to be an interesting one for sure. I really think though that a lot of stuff is yet to hit stats, right? Like there's going to be some cool stats in this release, but the subsequent releases down the road are probably going to be more eye-popping and jaw-dropping for folks than these ones. Because even the stuff I'm looking at right now, like Ryan and his great presentation on Friday, we see the change, we see the trajectory, but it's still a little bit early, right? Like June and May sales are really April and March pendings. And, you know, if they're March and April pendings, maybe they're February and March listings. So like the data we're getting now, it still lags, but the data we're going to get in August and September and October is really going to show how the market's changing. And then buyer sentiment is real. Buyer sentiment and how buyers react is a real thing. In turn, you know, you're going to see some sellers that are you know, maybe going to react in kind, and there's going to be opportunities for investors for sure. All right. It's hot in Oklahoma. That's a good point. Your boy Chet looking pretty good too. I mean, he's no Murray like we got in Sacramento, but he's all right. Chet Holmgren's all right. I'm not going to go on a Freddie Mac Home Possible rant, but your viewers should check out the new home lookup tool. Area median income, for anybody who was curious on what the heck Joey's talking about, it went up. You can look up, you can type in Fannie Mae AMI lookup tool or Freddie Mac AMI lookup tool, put in your zip code. It'll tell you what 100% of area median income is and 80% of area median income. If you're below 80% of area median income, Home Possible, Home Ready, there's different programs with 3% down conventional that you can get into if you're in that pool. And truth be told, these buyers, there should be more stuff coming. There should be more stuff on the horizon when it comes to subsidizing that demographic of buyers, low to moderate income buyers. That's what they've been talking about for a long time. And that's why they raised the prices on investment properties and second homes and high balance loans, is to subsidize the entry level stuff. So we shall see. What kind of rate do you think I could get on a 30-year bank statement loan with 10% down, excellent credit, but pretty high debt to income rate? If you can find a 10% down bank statement loan, expect to have a high rate, like 8%. I know most bank statement loans are going to be 20% down minimum. I guess if it's your primary residence, I should probably take that back. I wonder if I have the ability to do this real quick. Let me see if I can log in. I've got a quick pricer on non-QM stuff. Loan amount. How big are you buying? What's your credit? 90. 1 unit purchase. 24 months. Personal bank statements. Owner occupied. What you got? Well, their max LTV is 80, so that ain't gonna work. What else we got? Owner occupied. Requesting 90% LTV. Going once, going twice. All right. Well, I couldn't find it. A lender I thought might do it. So if you find that, it's going to be a higher rate just because you're 10% down in bank statement. But I don't want to guess. 7s or 8s. Final answer. That's my guess. Just an educated guess. I locked my rate, $499 for 30-year fixed. That's good. Deepak. Was there something before that? Yeah, depending on your loan size, I wouldn't necessarily look at a 5-1 or a 7-1 arm. Mobile homes It's a different type of loans. It's called chattel loans. So like any mortgage broker isn't going to be able to lend on that. It's a specific type of lender that's going to do that. Yeah, Zoobs can tell me. I got a bunch of YouTube buddies tell me how to block people. I wonder, let me see. Put user in timeout or block user. But bam, I just blocked user. Did it. Ha! That was easy. Implore. There you go. I implore you. Back to the beginning of this live stream, I was imploring people to not go out there and be a statistic. One of the 60,000 in June that canceled a contract, either due to not qualifying or not knowing what they were getting into. Do the work up front. Get yourself pre-approved. Know exactly what your payments can look like before you get into contract. I implore you. Thanks, Kelly. Appreciate that. Not sure if I should buy an investment property right now, or if I should wait a little bit. Rates are so high. A true sound. If you talk to my buddy Zoobs, who owns 180 rental units, or any other my investment friends, they would tell you this was a silly comment. I won't tell you it's a silly comment because I appreciate all comments. But the only thing that's going to change when rates change is your calculations, right? If you could pay $450 for a property and it fit your criteria of 10% cash on cash return, whatever you're looking for with your investment strategy, whether that's a certain number on cash flow, whether that's, a certain number of doors in a neighborhood that's going to appreciate in value by X percent over the next 10 or 20 years. Some people want cash flow. Some people want appreciation. Some people want a combination of both. But you get really clear on your criteria, whether rates are 4%, 5%, 6%, 12%, or 17%, it just changes the number you pay. So you can't pay $450 if the deal made sense at $450 at a 4% rate. But if the rates are 6%, you just have to adjust your numbers and say, you know what, I'm willing to pay $410 for this property. Then it's the same exact thing. And you offer the $410 price. A lot of people are going to argue that you're better off buying it at $410 at 6% than you would be buying it at $450 at 3%, because you can always refinance the monies into a lower interest rate, but you can't pull off the extra principal you owe. For some people, like I bought properties in 20 and 21, which might not have been great deals with a 5 or 6% interest rate, but I've got them locked in at 2.5, 2.875, 3.125, wherever these are locked in at. Kind of stuck with that loan and can't really touch it. You get a deal on something in 2022 where you offer less, but you have to take a higher interest rate. You've got the ability in the future to maybe refinance into a lower rate. So my 2 cents on that, my honest feedback, not trying to be, mean about it, but just being straightforward with you. I did a cash out refinance. So you're looking to invest. The good news is, like, a ton of people did this, and I commend you for doing this. I think it's really smart. A lot of people are sitting on a lot of cash. I wouldn't be in any hurry, right? Like, it was somebody really smart. I don't remember exactly who it was that I heard talking about, you probably heard this from me recently, where I'm like, I'm sitting on cash and it drives me crazy because it's dying against inflation. I want to deploy it. I want to go do something with it. And this person was reminding whoever they were talking to in this podcast about, like, don't deploy it for the sake of deploying it when, like, this money deployed today is going to get you something less desirable than something you can get 6 months from now. Because you might buy something 6 months from now that has a 5x return versus something you could buy today. And you feel better today because it's like giving you returns over the next 6 months, albeit little tiny ones, where an opportunity might be available in 6 months where you hit a home run, right? So I wouldn't necessarily be like, I got to get up there and swing and go hit a single just for the sake of not being in the batter's box. You might want to stay in the batter's box, wait for a great pitch, and hit a home run in 6 months from now. Again, my 2 cents. Best of luck to you. My wife and I are self-employed starting January 2021. Do we need to wait 2 years to try to get a mortgage? Really, a lot goes into that. There are definitely some lenders that will look at it with 12 months, depending on a bunch of different things. In a lot of cases, you'll have to wait 2 years. Yeah, you're going to have that 21 and 22 tax return and what, if, especially if like, yeah, there's no history of self-employed. But it's not necessarily always the case. I hate to say that. I hate to leave it so muddy. Reach out to us. Kyle and PA. 10% down bank statement. I heard the 1099 loans only require 10% down and they don't charge PMI since they aren't conventional loans. Are we talking 1099? Are we talking bank statement? Two different things. 1099 is just self-employed borrower. Yeah. More clarity. Another one we'll want to reach out to. Not clear enough picture to understand what we're looking for. A true sound. Yeah, I think waiting is perfectly reasonable, especially if you're an investor sitting on cash. My wife and I threw out a couple offers, weren't accepted, and we are not crying. Continue to look. Continue to offer on stuff that makes sense. If it makes sense, cool. If not, all good. More opportunity is coming. I guarantee you that. And my favorite season of real estate investing is going to be the season where you submit an offer, it gets rejected, and then lo and behold, that property is still available a month from now. The listing agent on behalf of the seller comes back and says, are you still interested in that property? And you go, well, I offered you $485 last month. I'm interested, but I'm not as interested. I'd be willing to write it up at $470. That's when you got them by the cojones. Viquez, ¿qué onda, amigo? ¿Cómo estás? Espero que todo está bien. Good night, everybody. Until next time, we gonna see.